This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, let's just take a moment, therefore, to review through what we've been looking at in our first two sessions on inheritance tax. What we've seen as regards chargeability to IHT is that the main scenario where any taxpayer may fall foul of the inheritance tax system is, sad to say, upon their death. That's the usual situation where the vast majority of taxpayers will have their one and only encounter with IHT. But what becomes chargeable to IHT on your death? Well, where we started with, and very obviously, the content of what we call our chargeable estate at death, our death estate there. That's again simply like a little balance sheet for the taxpayer as of the date of his death, where we list out the assets held, maybe applying a valuation rule or two in computing what those asset values are. And away from those assets, we take away any liabilities, any debts due at the date of death. We take away also any reasonable, as we call them, funeral expenses. And what we'll also do is to deduct any exempt transfers. The exempt transfer that we need to be aware of, the only one we need to know in our taxation F6 syllabus here, the only one we need to know is a transfer to spouse or civil partner. What we will see, of course, in an exam question is where the taxpayer who sadly dies in our question will not be leaving everything to his or her spouse, even if there is one, because that would make it a very simple question. There'd be no IHT. Instead, what we'll be doing is to bypass the spouse, or just leave a little bit to a spouse, should there be one, and then leave the rest of the estate, presumably to your nearest and dearest, the undeserving children. So, in addition to, and in fact prior to, computing the tax on that chargeable estate at death, once we've listed out the assets, taken out the liabilities, taken out our reasonable funeral expenses, taken out our exempt legacies of transfers to spouses or civil partners there, that chargeable estate that we come up with is the second computation to actually perform. Because before we tax it, what we must firstly do is to look back over the lifetime transfers that have occurred, but only within the 7 years of the date of death. What we're not going to simply allow is for only the content of the estate at death to be chargeable to IHT. As we said, that would make it very easy to avoid IHT if, sad to say, you knew that you were not too much longer for this world, because just give everything away before you died, and then you'd have nothing left to be charged to IHT. So there has to be a time period that is used, and as we know well by now, I trust, it is transfers made within the 7 years before death. Although we have spoken of two types of transfer, the only one that we have dealt with in terms of computational is the one most likely again to be experienced by most taxpayers, what we call PETs. There's a lovely acronym, PETs, P-E-Ts, which of course means a potentially exempt transfer. A potentially exempt transfer. So when it's made, there is no IHT. The only time any IHT is payable in lifetime, when you make a transfer in lifetime, is here. Transfers into trusts. Now, we've made brief mention of this. We do not look at the calculation of this tax in lifetime at this point, nor indeed in this lecture, but in a later lecture. But if in lifetime you made a transfer into a trust, it would be labelled a CLT, a chargeable lifetime transfer. It would then be chargeable by reference to the lifetime rates and to the available nil rate band that existed at the date of the CLT. What then happens, of course, on death, at the date of death, prior to taxing the content, as we've said, of the chargeable estate at death, we list out those lifetime transfers that occurred within the 7 years of the date of death. And we list them out in chronological order, going back to the very first transfer within the 7 years from the date of death and starting with it. Now, it could either be a PET or it could be a CLT. PETs, as we've said, there was no IHT payable when the transfer was made. There is only one occasion of charge, and that is if you die within 7 years of having made them. Whereas if a CLT should also fall within the 7 years of the date of death, then not only was it chargeable in lifetime, but it's now also chargeable on death. Now, as we'll discover again in a later lecture, you will not end up paying both a lifetime rate plus a full death rate. We know the death rate to be 40% there. We do not do that. All we will do is to compute using the normal rate at the date of death, 40% above the nil rate band. We'll compute whatever tax charge may arise on that basis, but we will deduct any lifetime tax paid. So we'll only be computing here any additional tax that needs to be paid. Any additional tax there that needs to be paid. That's all. Okay, so on death, therefore, chargeable estate at death, easy to compute. It's basically a listing exercise, but before taxing the content of the chargeable estate at death, we must firstly deal with the transfers made in lifetime within the 7 years before death, pets becoming chargeable for one and only time, CLTs potentially becoming chargeable for a second time. Now, what are the issues in computing our tax charges here? Well, in relation to any pet or CLT, we must compute the transfer of value. Now, that we defined not as being the market value of the asset when we gifted it, though that is usually in point of fact the same as the transfer of value, but we very specifically defined the transfer of value as being the difference between what the taxpayer had before the transfer and what he had after the transfer. We defined it as the loss to the estate of the donor. That, again, difference between what he had before and after. Now, with most assets, as we said in the earlier lectures, that's usually the same as the market value of the asset being gifted. But with certain assets, and our favourite there, and the examiner's favourite, will be shares in an unquoted company, we have different valuations of a share, a price per share, based on the level of shareholding that you have. The bigger the shareholding, the higher the share price. So we must compute the transfer of value. What did he have before compared to what did he have afterwards? That difference is the loss to the estate of the donor. So we compute the transfer of value. What we must then do is to compute, and we won't see that in this particular session, but we'll see it in a later session. From the basic transfer of value, there are various exemptions that might apply in lifetime, and where applicable, we'll deduct them in deriving a figure that we've mentioned already in the exercises we've done, the chargeable transfer. But of course, when we tax these lifetime transfers, these chargeable transfers, what we have to do is to firstly apply a nil rate band. That nil rate band is applied to, on death, the lifetime transfers made within the 7 years of the date of death, and it is applied in chronological order. The first transfer got the benefit, first transfer within 7 years before the date of death, got the benefit of that nil rate band. Then the next one, until that nil rate band was fully used. If it wasn't fully used by the date of death on the transfers within the 7 years of the date of death, why? Because they didn't exceed 325,000, the existing and current nil rate band there, that if we didn't use it, or then the balance of any nil rate band would be available to go against the chargeable estate at death, and only the excess would then be chargeable at the death rate of 40%. So the nil rate band that we had was applicable both in relation to lifetime transfers and also the death estate. But it was just that lifetime transfers got the first use of that nil rate band. But then we discovered there was another nil rate band, the residence nil rate band. Now, whereas with the nil rate band, lifetime transfers got the benefit of it before the death estate took any benefit, and if those lifetime transfers exceeded the 325,000 nil rate band, then the whole of the death estate would be taxable at 40%. But the residence nil rate band was very different. It was only available on the main residence, so there must be reference in the question to in the death estate. Note, in the death estate, that there was a main residence. So the residence nil rate band is not applicable to lifetime transfers. It is only applicable where a main residence, it must be specifically mentioned as being within the death estate, is in that death estate, and even that isn't enough to apply this residence nil rate band, that £100,000 residence nil rate band. Oh no, for it to be available, then that main residence must be bequeathed to a direct descendant, i.e. your children or your grandchildren there. Okay, let's just remind ourselves of what we did in terms of the use of the nil rate band anyway, by looking back at illustration 7. Now, we've done this already, but let's just remind ourselves. Now, as in illustration 4, but D had made 2 chargeable transfers in lifetime, you'll see reference there to that expression chargeable transfer. As I said a moment ago, that will be the transfer of value less any available lifetime exemptions. We look at those in a later lecture. So we've got 2 chargeable transfers of £200,000 each, the first in June 15, the second in August 16. The date of death in relation to this, if I just take you back to illustration 4. Now, illustration 4 picked up on illustration 2, and illustration 2 all the way back to that first detailed exercise we did. She died, bless her, departed, died on the 1st of February 18, leaving an estate valued at £750,000. It did include her main residence, valued at £300,000. She'd made there no chargeable transfers in lifetime and bequeathed her estate, critically here, to be split between her nieces and nephews. So even though there is a main residence in that estate, there is no residence nil rate band because it went to nieces and nephews. So back there was no lifetime transfers. We simply applied the nil rate band against the death estate. On to illustration 4, we introduced a chargeable transfer in lifetime, £200,000 in June 15. It used up 200 of the nil rate band, leaving for the death estate only 125, pushing an extra 200,000 out of the nil rate band and up into the 40% band. Then in illustration 7, what did we do? We brought in a second lifetime transfer. So in terms of our computations, lifetime transfers chargeable on death, back 7 years from the date of death, and that picks up in order the earliest lifetime transfer first. That was June 15. It was a pet, now becoming chargeable for the one and only time, only 200, all within the nil rate band, no tax. Next one, also £200,000, same as the first one, but a very different outcome in terms of a tax charge. There is now only 125 of the nil rate band remaining, pushing therefore 75,000 of this pet, the same gross transfer of 200, into the 40% band. A £30,000 IHT charge arose. What then, of course, then it meant that on that basis, we had used all of the nil rate band in relation to lifetime transfers. So that meant that as the nil rate band had been fully used on lifetime transfers, the entire chargeable estate of 750 was going to be taxed at 40%. The whole lot was pushed out of the nil rate band. So moving on from what we've seen there, we can obviously see that if the taxpayer survives for more than 7 years from the date of the pet was not chargeable when made, you live for more than 7 years, what was potentially exempt when made becomes exempt. It will not be chargeable. What that will mean, it will be both exempt in its own right, there will be no tax to pay on it as a result of the later death of the taxpayer, And remember, IHT is a cumulative donor-based tax. Look at the example we've just reminded ourselves of. 2 transfers, both of £200,000, same amount going to each of the 2 beneficiaries there, but the amount they end up with is very different. On the first transfer, no tax to pay. On the second transfer, £30,000 tax to pay. The individual, therefore, would only benefit by a net £170,000 out of the 200 given to them in lifetime. They then have to pay out £30,000 tax. So it's a cumulative donor-based tax. But if a pet is more than 7 years from the date of death, it has no effect on the calculations of tax. It is not chargeable, and equally, it will have no effect on the chargeability of either those lifetime transfers within the 7 years before death or on the chargeable estate itself. Simply illustrated, looking at illustrations 4, and that's why we've looked at them again now. If we had an earlier pet, again £200,000, but this time 8 years before the date of death, it would be exempt and would have no effect on the amount of IHT payable on either of the later pets or on the chargeable estate. You'd have exactly the same answer as you had in illustration 7 there. As we've been making the point that in relation to those examples, the nil rate band was relevant, as it always is, in dealing with lifetime transfers becoming chargeable on death and using any nil rate band prior to using any remaining nil rate band against the chargeable estate. But if there's a residence nil rate band available, that does not apply to lifetime transfers. I'll cross that out, try to underline it. Does not apply, that's better, to lifetime transfers. They become chargeable as a result of the donor's death within 7 years and will only be used in computing IHT payable on the death estate. So remember, the ingredients that you're looking for to apply the residence nil rate band. You must have a main residence, again that term will be used, that is contained within the chargeable estate at death. Not applicable to lifetime transfers, only where a main residence is within the death estate. And only where that main residence in the death estate is bequeathed to a direct descendant. As we know, a child or grandchild there is what we're talking in terms of. All those ingredients have to come together. All right. If we just move on to have a look at illustration 9. Now we're told here that Daisy died on the 13th of April 2017, so in the 17-18 tax year, leaving a death estate, the chargeable estate at death, valued at £500,000, and which included her main residence, valued at £300,000. Daisy's entire estate was left to her grandchildren. Right, the things we have to put together here. We know that we have a death estate of 500. In an exam question, you may have to work that out for yourself, of course, by adding up the assets, applying a valuation rule, like, for example, there's a life policy, so you have to use, therefore, the proceeds of that life policy, not the market value at the date of death. You have to take away the debts and liabilities, only legally enforceable ones, things like credit card bills, for example, there. Again, only if a real debt, only if legally enforceable will it be deducted. Take away your funeral expenses, take away your exempt legacies, you've got your chargeable estate there. But only if in that estate that we have here a main residence, so you pick up on that and you pick up on that. It's going to a direct descendant. So you now know that the residence nil rate band will be available. And as that is 300,000 and our residence nil rate band is 100,000, a full £100,000 will be available. Only remember to go against the death estate in terms of its taxability. We're also told that on the 30th of June 15, Daisy had made a pet of £375,000 to her daughter. Right, so we got a lifetime transfer made within the 7 years of the date of death. It being a potentially exempt transfer, it becomes chargeable on death, and it will be charged tax before dealing with the death estate. So we set up our computation. Lifetime transfers chargeable on death. Now again, I'm showing you the proper full format to use here if it were a written question. The likelihood is that you'll be dealing with Section B questions, 5 of them on a Section B question as OT questions, objective testing. So although you still have to do this, you can do it just in brief note form. We don't have to adhere to strict, again, presentation techniques, as long as you can get the right answer at the end of it. But you've still got to know how to lay the computation out to be able to get that right answer. But you can do it in rough. So lifetime transfers chargeable on death. We need to record the gross transfers. We need to record the tax. There is only one pet, dated the 30th of June 15. It amounts to 375. We've immediately exceeded the 325 nil rate band, pushing 50,000 out of the nil rate band into the 40% band, and therefore £20,000 of tax to be paid there by the daughter in relation to the gift that she received in June 15. Then the death estate. We know that the total is 500, but we were informed it included a main residence of 300, so it must mean that the other net assets come to £200,000. How do we compute that Iht liability? Well, we've already used the nil rate band, but we will apply the residence nil rate band first anyway, whatever. It is available, 100,000 at nil. Out of the 500, 400 left at 40%, £160,000. And so we compute the Iht payable on the death estate. If again we had to, and we'd only do it if we had to, if we were specifically asked, state when the tax would be payable, then of course that is 6 months after the end of the month in which the death occurred. And that is true for all tax arising on death, whether it be on lifetime transfers chargeable on death, or whether it is the death estate itself there. Okay, now we've seen the format of the computations for lifetime transfers chargeable on death and the death estate, and we've seen the applicability of the nil rate band so far as both lifetime transfers are concerned, and also the death estate, if there's any remaining after applying it firstly against those lifetime transfers. We've seen the residence nil rate band, only available if, as here, there's a main residence within the death estate, and of course it is bequeathed to a direct relative. Well, we've got something else now that is new and makes it even more interesting as regards the usage of these nil rate bands. And it's very good news so far as the taxpayer is concerned, if of course anything arising out of death could be said to be good. So if you can turn to section 3.2 here, that is on page 141. So go back to page 141, and what we have is the potential to transfer on the death of one spouse or civil partner any unused nil rate band, any proportion of their nil rate band that is unused, across to the surviving spouse. Now this of course could be of significant advantage. If any amount of a taxpayer's nil rate band is unused on their death, then the proportion, so we'll be computing that as a percentage, we won't be computing it as a value figure of 100,000, 200,000, 325,000, whatever it might be. We'll be computing it as a percentage there. Then the proportion of their nil rate band that is unused will transfer through to their spouse or to their civil partner, should they have one there. Okay, now then, this is an incredibly important practical issue. Again, it's very likely to be tested, but in real life, in terms of Iht, when this was brought in, and it's only about 10 years ago that this was actually brought in, it radically changed planning in relation to Iht, so far as spouses were concerned. Back before we had the transferability of an unused nil rate band, think what would happen on the death of the first spouse. Normally, on the death of the first spouse or civil partner, they are likely to leave it to the other spouse or civil partner, and transfers between spouses are exempt. So that would mean first spouse dies, leaves everything to surviving spouse. Before this rule came in, only 10 or so years ago, then that would mean that the first spouse's death, we didn't use any of the then nil rate band. And then we lost it. Back in the bad old days there, if you didn't use your nil rate band by the date of your death there, on your death, then it was wasted. And what would happen? The value of your property would then go across to the surviving spouse, so he or she would now have the total combined value of your overall property and only one nil rate band to be able to utilise when that surviving spouse died, presumably then left it to the kids. Now that was a dreadful scenario, and it created all sorts of planning issues and the use of trusts in an attempt to try to use up the nil rate band and not waste it. All of that then disappeared, and it became a simple thing that if, when I die, my wife has told me this, that I'm going to be dying first apparently, but if when I die, I leave it all to my spouse, I will be leaving everything, of course, well, what little there is, to my spouse there. Why? Because she told me to. So I'll be leaving everything to her. That will mean I will have made no use of my nil rate band. And whatever the nil rate band may be at that date, whether it's 325 or any bigger figure of that, if I have used none of it, then 100% of my nil rate band, 100% unused nil rate band will transfer across to her. And then, sadly, when she dies, and presumably leaves it to the children, she will get not just her nil rate band at whatever figure it is at the date of her death, she'll get an extra 100% on top of that. So she'll get 200% of the then available nil rate band. So it wasn't a problem. Well, it was a problem to me when I died, but it wasn't a problem so far as IHT was concerned because of this incredibly important rule that we have here. Because all that would happen, she would now benefit not just from the 325,000, the existing nil rate band, if it were to be that number on the death of the first spouse there, but 100% would transfer across. So if when she died, the nil rate band was then £400,000, she would get 100% extra on the 400, £800,000 of nil rate band would be available on her estate. So very good news indeed as regards mitigation of IHT liability in terms of succession planning and how to get from one generation to the next the value of any estate that you may have accumulated over your lifetime. Illustration 5 shows us what is happening here in relation to this. If we just read through, if in the above illustration 2, go back to illustration 2, so go back and have a look at it if you need so to do, it was where D died with a £750,000 estate. D was a widow, I think she was a spinster in our original illustration, and received all of her husband's estate on his earlier death. And he had made no lifetime gifts. The husband would have made no chargeable transfers, as transfers between spouses are exempt. This would mean, as we've just been talking about, that 100% of his nil rate band would have been unused. As D has then died, a claim may be made for the unused proportion. The executors of the estate will do this, and of course they will make this claim, but it has to be made. It doesn't happen by itself. A claim may be made for the unused proportion, in this example 100%, of the husband's nil rate band to transfer through to D. So D's nil rate band would now be the original 325 plus an extra 100% of 325. Now remember, we don't just add on what was the amount of the unused nil rate band that existed at the date of the death of the first spouse. It is a proportion that is unused that transfers to the surviving spouse, here 100%, and if again the surviving spouse dies when the then nil rate band is 400,000, he or she would then get £800,000, an extra 100%. So what would it do in D's case? It would allow an additional amount of tax of 130,000 to be saved, i.e. you've taken another 325,000 out of the 40% band and put it back into the nil rate band. Note that, as we've been saying, irrespective of the level of the nil rate band that existed at the date of the husband's death, whether it was 325 then or a lower figure, D will now benefit from an extra 100% of the available nil rate band when she dies. It's even better. Illustration 6. Now, we've just been looking at the normal nil rate band, and before the 1718 tax year, that was all we had. But from the 1718 tax year, of course, what do we now have? We now have not just the normal nil rate band, of which any unused amount could be transferred to a surviving spouse or civil partner, but we also have now a residence nil rate band. And so it is that also this would be transferable if unused, again on the same basis. Whatever proportion of the 100,000 nil rate band is unused, then that will transfer through. And again, it does not matter when the first spouse died. You may be wondering here how this would work, because we've only brought this in from 1718. If therefore a widow were now to die in the 1718 tax year, or at any future point in time there, and her husband had died before 1718, before the residence nil rate band existed, that guarantees that there's 100% unused residence nil rate band that is available, therefore, to the surviving spouse. So as a matter of course, that's going to be an extra 100,000 residence nil rate band. And as long as within her estate she has a main residence with a net value after any repayment mortgage or any interest-only mortgage had been deducted from it, as long as that is at least £200,000, then the full residence nil rate band will apply. Again, of course, for it to be available only where the main residence is in the death estate, and only where, of course, it's bequeathed to a direct descendants, the kids or the grandchildren. So, if in illustration 3 above, D was a widow when she died, so again, go back and have a little look at illustration 3. If D was a widow when she died, and her husband had made full use of his normal rate band, nil rate band on his earlier death, then now the IHT computation would be as follows. So we've said that D's a widow, husband when he died before the 1718 tax year, had made full use of the only nil rate band that existed then, the normal nil rate band. So none of that is unused, none of it is transferable. But he couldn't have used any residence nil rate band because it didn't exist before 1718. So what do we now have as an available nil rate band? We've got the very specific applicable 200,000, 100,000 plus 100% of 100,000 there, 200,000 now residence nil rate band, and of course we've got our own ordinary nil rate band of 325. That therefore again reduces what is pushed up into the 40% band, and now it's only 225, reducing the tax charge down to £90,000. To remind ourselves of the types of lifetime transfer that exist, as we have made reference to from the beginning of this particular session, lifetime transfers are either exempt, transfers to spouses, transfers to civil partners. If they're transfers into trusts, they are CLTs. We are still to see how to deal with those, but what we have been dealing with is every other type of transfer that you might see that is not exempt or is not a transfer into trust. and those are pets. We've seen, therefore, how to identify each such transfer, and we've recognised when they become chargeable. And we work through the stuff on section 4 there, on pets, and through the illustrations that related to it. We've reminded ourselves of illustration 7 in this particular exercise here, and we've seen how it is that the nil rate band and, of course, the residence nil rate band would apply. And we've followed through, and we've seen in terms of illustration 9 how we've used the residence nil rate band. You'll have noticed here that we haven't applied any unused nil rate band that may have been available, because there's no mention here of Daisy's husband having predeceased, and if he did predeceased, having any proportion of his nil rate band unused. That must be evidence within the question for any unused nil rate band to be applicable. Okay. Last thing that we'll have a little talk about here, taper relief. In the examples that we've done so far, any pets that become chargeable on death have actually either had no tax to pay on them, or why do they have no tax to pay on them? Why, of course, because they were within the nil rate band. And those that fell out of the nil rate band, that took the cumulative total in the 7 years before death above 325, those fell within 3 years of the date of the death of the taxpayer. Now, that was for a reason, because if the taxpayer does not survive for 7 years following the pet, but does survive for at least 3 years, then if there is any IHT payable, again, there may not be. You may have a transfer like we've seen several years before the date of death that becomes chargeable, but it's all at the nil rate, so there's no tax. But any IHT that is payable on the transfer is reduced by taper relief. And this works, the table in fact is provided in the exam, but it works in a very structured form of moving in 20 percentage points. This is the relief. And it looks at the time difference between the transfer being made and the date of death. So if you manage to survive for more than 3 years, but not more than 4 years from the date of the transfer to the date of death, 3 to 4 years, then you get a 20% reduction in the tax charge. And it moves up in 20 percentage points, such that if you managed to survive for between 6 and 7 years, just think, such bad luck. You know, if you had lived for over 7 years, then there'd be no tax at all that would be payable in relation to that transfer. If, of course, you died 6 years and 11 months there after the date of the transfer, then it would become chargeable. But thankfully, though it becomes chargeable, not all of any tax that is payable on it is payable, because we will get an 80% reduction in the tax charge. Now, do please note that the reductions that we're talking about are reductions in the inheritance tax payable. We are not talking about a reduction in what is chargeable to tax. We're not reducing the chargeable transfer, the pet. We're not reducing that value. What we are doing is, if any amount of the chargeable transfer of the pet, again later CLTs as well, but if any amount of that is above the nil rate band and is taxed at 40%, then that tax, it is that is reduced by this taper relief, from a minimum 20% reduction to a maximum 80% reduction. So, what you have here is illustration 10 that tells us, as in illustration 7, but the 2 lifetime transfers of £200,000 occurred in January 12 and June 14 respectively. Now then, again remind ourselves, in illustration 7 there, if I can find it, in illustration 7, here we go, we had the transfers occurring in June 15 and August 16, and we'd had a date of death. Oh, we have to go all the way back to find our date of death from illustration 2. And that, I bet your eyes are spinning now, died on the 1st of February 18. So that was the critical date for the chargeability of pets. Right, let's whack it all the way back through to our illustration here. Illustration 10. And what we've now got is that these two transfers, January 2012 and June 14, these are occurring more than 3 years before the date of death. So what do we do? To begin with, exactly the same as we did before. So the first pet, 200,000, all within the nil rate band, there is no tax to pay. Remember, taper relief reduces the tax charge, not the transfer. On to the next transfer, June 14, pet 200,000, 125 nil rate band left, 75,000 at 40%, 30,000, same figure as we had before. But now there's a difference, because this time the taxpayer has survived for more than 3 years, albeit not more than 7 years, from the date of the transfer to the date of death. So you count through from the date of the transfer through to the date of death, and you establish, have we survived for more than 3 years? Did we survive for more than 4, more than 5, more than 6? To establish, is it as here, as the pet falls between 3 to 4 years from the date of death, the tax charge may be reduced by the taper relief of 20%. That is a reduction in the tax charge. 20% of 30,000 equals 6,000. So the amount, therefore, of tax to pay will only be £24,000. As in illustration 7, the nil rate band has been fully utilised on the lifetime transfers made in the 7 years before death, so the entire chargeable estate is going to be taxed at 40%. Okay, now again, check through all of these examples. Again, make sure before next session you check through this example. I'll be testing you on that indeed at the start of the next session to check that you have. Make sure you do, so that we can then progress on and see what else awaits us in this lovely story of death and inheritance tax there.